December 12th, 2025, Friday. Silver closed at $61.92 per ounce. Markets shut down for the weekend. But before the close, something extraordinary happened. Silver hit an intraday high of $64.65, all-time record, the highest price in silver's history. Then it pulled back, hard. Down over 3% in hours, profit-taking, consolidation, call it what you want. Now it's Sunday, December 14th, 2025. Markets closed, silver frozen at $61.92. And when markets reopen Sunday at 6 p.m. Eastern Time, the question everyone's asking is the same. Does silver break out to new highs above $65, or does it collapse back down? Because here's what you need to understand. This isn't random price action. This is the exact pattern silver has shown before every major breakout in history. The pause before the explosion, the consolidation before the vertical move, and right now we're watching it unfold in real time. Let me show you exactly what happened on Friday. Why silver is stuck at $61.92, the three forces that pushed it to $64.65, the two barriers holding it back, and what the timeline says happens when markets reopen in less than 6 hours. This is purely educational analysis, pattern recognition based on publicly available market data, not financial advice, just observation of what's unfolding right now. Let's start with Friday, December 12th, the day silver made history. Markets opened with silver around $63. Strong bid, momentum building. Then shortly after the open, silver spiked, $63.50, $64.4, $64.50. At approximately mid-morning Eastern Time, silver touched $64.65 per ounce. That's the all-time high, higher than the inflation-adjusted 1980 peak of $50, which equals roughly $170 in today's dollars when adjusted, higher than any point in the 2011 rally, the highest price ever recorded in silver's trading history. For a brief moment, silver was making history. Then sellers appeared, heavy selling, profit-taking from traders who had ridden the rally from 27 in September 2024. That's a 140% gain in 15 months. When you're up that much, taking profits at all-time highs makes sense. The selling accelerated. $64 broken, $63 broken. By early afternoon, silver was trading below $62. According to multiple market reports, silver fell approximately 3% from its intraday high. It closed the day at $61.92. Now, most people look at that price action and think the rally is over, top is in, sellers won, time to exit. But that's not what the data shows. Look at the context. Silver opened Friday already up over 100% year to date. It hit an all-time high during the session. Then it pulled back 4% and held above $61. That's not distribution. That's not panic selling. That's healthy consolidation after a parabolic move. Look at volume. According to trading data, volume spiked when silver hit $64.65. Heavy volume on the high. But here's what matters. After the pullback, volume declined significantly. Light selling. Minimal panic. The price didn't crash. It consolidated. It's holding a higher low. In technical analysis, this is called a bull flag or ascending triangle. Both are continuation patterns that typically resolve to the upside. Now let me show you the three forces that pushed silver from $27 to $64.65 and why they're still accelerating even with markets closed. Force number one, industrial demand at record levels. Silver isn't just a monetary metal anymore, it's a critical industrial commodity. And the sectors consuming silver are all expanding rapidly. Solar panels require 15 to 25 grams of silver per panel for the conductive coating. According to the Silver Institute, industrial silver demand hit a record 680.5 million ounces in 2024. That's an 11% increase year over year. Solar is the biggest driver. Global solar installations doubled compared to 2 years ago. The International Energy Agency projects solar capacity could exceed 500 gigawatts annually by 2030. New solar cell technologies like TOPCon require 50% more silver than traditional panels. So as the industry upgrades, silver consumption per panel increases. This is structural demand backed by government policy. China plans to add 160 gigawatts of solar capacity in 2025. Europe targets 700 gigawatts by 2030. India is electrifying its railway network by 2030. Every panel built permanently removes silver from available supply. Electric vehicles use 25 to 50 grams of silver per vehicle. Traditional cars use about 15 grams. That's double to triple the silver content. EV production is exploding. In 2023, EVs represented 18% of global car sales. By 2030, the International Energy Agency projects that number exceeds 60% in major markets. The global EV market is projected to hit 20 million units in 2025. At an average of 30 grams per vehicle, that's 600 metric tons of silver consumed by automotive alone this year. Data centers and AI infrastructure, This is the demand driver almost nobody's talking about. Global IT power capacity increased from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. Every data center, every AI server, every computing system requires silver for electrical connections and circuit boards. The Silver Institute project's data center expansion will add significant silver demand through 2030 as AI adoption accelerates. When you add it up, industrial silver demand is projected to exceed 700 million ounces in 2025. That's demand that must be met. There's no substitute for silver in these applications. Copper and aluminum don't match silver's conductivity. This demand doesn't stop because silver pulled back 3% on Friday. Solar panels continue being built. EVs continue being produced. Data centers continue expanding. This is locked-in structural demand. Force number 2, supply deficit entering 5th consecutive year. While demand explodes, supply shrinks. According to the Silver Institute, the silver market has been in deficit for 5 consecutive years: 2021, 2022, 2023, 2024, and 2025. The cumulative deficit from 2021 to 2024 totals approximately 678 million ounces. That's equivalent to 10 months of global mine production, just consumed, not replaced. The 2025 deficit is projected at 117 to 149 million ounces, depending on the source. That means demand exceeds supply by that amount every single year. Where does that silver come from? Above ground stockpiles, vaults, reserves. And those reserves are being drained. COMEX inventories tell the story. COMEX is the commodities exchange in New York where silver futures trade and where physical silver is stored. There are 2 categories: eligible silver, stored but not available for delivery; registered silver, available for delivery against futures contracts. According to market reports, registered silver at COMEX has been declining. In May 2025, approximately 12.7 million ounces were transferred from registered to eligible in a single day. That's 8% of registered inventories reclassified overnight. Registered silver now stands at approximately 156 million ounces, according to recent data. When futures contracts mature and traders demand physical delivery, only registered silver can fulfill those contracts. If registered inventories decline further, COMEX faces a delivery squeeze, and delivery squeezes drive prices vertical. The London Bullion Market Association shows the same pattern. LBMA silver inventories fell 4.93% in September alone. They've declined for 10 consecutive months, according to market observers. Silver is leaving vaults, it's being consumed by industry, bought by investors, or moved into private storage, and it's not being replaced by new mine production. Why? Because silver mine production has declined approximately 7% since 2016. Most silver comes as a byproduct of copper, zinc, and lead mining. When base metal prices are weak, miners don't expand operations. Silver supply doesn't increase. According to reports from major mining companies, capital expenditure plans show 0 new projects with significant silver byproduct coming online before 2030. The supply squeeze is not temporary, it's structural. It's locked in for years. Force number 3, investment demand surging. Silver ETFs absorbed 95 million ounces in the first half of 2025, according to industry reports. Global holdings in silver exchange traded products reached 1.13 billion ounces. ETF inflows are direct measures of institutional and retail investment demand, and they're accelerating. Why? Inflation remains elevated. The Fed's own projections show PCE inflation finishing 2025 at 2.9%. That's well above the 2% target. With real interest rates near 0, hard assets like silver become attractive. Silver is perceived as a hedge against currency debasement. Lease rates confirm the squeeze. Silver lease rates hit approximately 30% annualized in October 2025, according to market reports. That means people were willing to pay 30% interest just to borrow physical silver. That's not normal. That's desperation. That's institutions scrambling for physical metal to fulfill obligations. Rising lease rates and borrowing costs in London point to genuine delivery stress, not speculative positioning. So those are the 3 forces. Industrial demand at records and accelerating. Supply and structural deficit with inventories draining. Investment demand surging as confidence in fiat currencies erodes. These forces pushed silver from $27 to $64.65, and they don't change over a weekend. They're still building pressure even with markets closed. Now let me show you the 2 barriers that held silver back at $61.92 on Friday, why it couldn't hold $64. Barrier number 1, technical resistance at $65. Silver hit $64.65 on Friday. It came within 35 cents of the $65 level. That's a major psychological resistance point. Round numbers matter in trading. $60, $65, $70. These are levels where sell orders cluster, where profit-taking accelerates, where momentum stalls. Silver tested $65 and failed. It couldn't break through. Until it breaks convincingly above $65, traders remain cautious. A breakout above $65 would trigger technical buying. Momentum traders would pile in, algorithms would recognize the pattern, the move could accelerate quickly toward $70. But Friday, it didn't happen. Silver hit resistance and pulled back. That's normal technical behavior after a parabolic rally. Barrier number 2, Federal Reserve policy uncertainty. This is the critical factor. The Fed met December 10th and 11th, just before Friday's trading. They cut interest rates by 25 basis points. The federal funds rate is now 3.5% to 3.75%. That's the third consecutive cut. On the surface, that's bullish for silver. Lower rates mean lower opportunity cost of holding non-yielding assets. Lower rates weaken the dollar. A weaker dollar makes dollar-denominated commodities more attractive to foreign buyers. But here's the problem. The Fed's dot plot, which shows where Fed members expect rates to go, indicated only one more cut in 2026. Just one. That's much slower easing than markets expected. Fed Chair Jerome Powell said in the press conference, "We are well positioned to wait and see how the economy evolves." Translation: don't expect aggressive easing. Market reaction was mixed. Treasury yields moved higher in some maturities. The dollar strengthened slightly, and silver, which had been rallying into the Fed meeting, stalled. Traders are reassessing the path of interest rates. If the Fed only cuts once in 2026, rates stay elevated longer. The dollar potentially stays stronger longer. That's a headwind for silver. That's why silver consolidated at $61.92 on Friday instead of breaking higher. Technical resistance at $65, combined with Fed policy uncertainty, created a temporary ceiling. But here's the counter-argument. The Fed's projections assume inflation continues falling and the labor market remains stable. Both assumptions are questionable. Inflation ticked up in late 2025. The Fed's forecast shows PCE at 2.9%, well above target. Unemployment has been edging higher according to recent data. If inflation stays sticky or if the labor market weakens, the Fed will be forced to cut more aggressively than the dot plot suggests. And that would be massively bullish for silver. So silver closed Friday at $61.92, consolidating. Building energy. The forces pushing it higher, industrial demand, supply deficit, investment flows, they're all still in place. The barriers holding it back, technical resistance and Fed uncertainty, are temporary. Now let me show you what happens when markets reopen Sunday at $6 p.m. Eastern. The two scenarios and the timeline. Scenario 1, breakout to new highs. This is the bullish case. Silver opens Sunday evening with buying pressure. Maybe Asian markets drive demand. Maybe institutional orders accumulated over the weekend hit the market. Silver breaks above $62, then $63. Momentum builds. By Monday morning, silver tests $64.65, the Friday high. It breaks through. Technical resistance at $65 shatters. Algorithms trigger buy orders. Momentum traders pile in. Silver runs to $67, then $70 within days. In this scenario, the Friday pullback to $61.92 was the shakeout. Weak hands sold, strong hands held. And when markets reopened, the rally resumed. The consolidation was just a pause before the next leg higher. What drives this? Several catalysts could trigger the breakout. Economic data released over the weekend or Monday could show inflation running hotter than expected, forcing markets to price in more Fed cuts. Geopolitical events could drive safe haven buying. A major institutional buyer could announce a large silver position. Or simply, technical momentum could resume as traders recognize the Friday pullback as a buying opportunity. If silver breaks above $65 and holds, analysts suggest targets of $75 to $90 by late 2026. Some independent analysts mention $100 per ounce if supply conditions tighten further and paper markets face stress. Historical precedent supports this. In 1980, silver hit $50, which adjusted for inflation equals approximately $170 today. Scenario 2. Collapse back to support. This is the bearish case. Silver opens Sunday with selling pressure. Maybe profit-taking continues from Friday. Maybe large holders decide to exit positions. Silver falls below $61. Once $61 breaks, momentum shifts. Stop-loss orders trigger. Algorithmic selling accelerates. Silver falls to $56, then $55. The rally is over. The Friday high of $64.65 was the top. What causes this? The Fed could signal more hawkish policy than expected in communications over the weekend. Economic data could show the economy stronger than expected, reducing the need for rate cuts. Industrial demand could show signs of slowing, maybe from a recession in China or Europe. Or investment demand could evaporate as traders rotate out of commodities into equities. In this scenario, silver falls from $61 to $50 over the next month, an 18% decline. The bull case is broken. Silver returns to its previous trading range. Which scenario is more likely? Based on the data, the bullish scenario has the edge. The structural drivers are real and locked in. Industrial demand isn't slowing. Solar, EVs, data centers continue consuming silver. Supply deficit is locked in for years. Mine production isn't increasing. Investment demand has strong underlying support with elevated inflation and low real rates. The only major risk is if the Fed turns aggressively hawkish. But the December dot plot doesn't suggest that. They cut 3 times in 2025. They're projecting at least one more cut in 2026. The direction is easing, not tightening. The base case is consolidation followed by breakout. Silver holds above $60 when markets reopen. It tests $65 over the next few weeks. Eventually it breaks through, and once it does, the move accelerates towards $75 to $90. The timeline. Sunday, December 14th, 6 p.m. Eastern. Markets reopen. Silver opens between $61 and $63. Light weekend positioning. Monday, December 15th, full trading resumes. Volume returns. Silver tests Friday's range. Either it reclaims $63 and pushes toward $65, or it breaks below $61 and falls further. December 16th to January 2026, consolidation phase. Silver trades between $60 and $65, testing resistance multiple times, building energy for the next move. This is the bull flag pattern completing. February to March 2026, breakout phase. Silver breaks above $65 on increasing volume. Momentum builds. $70 resistance is tested and broken. Silver reaches $75 to $80, April to September 2026. Extension phase. Silver consolidates at $75 to $80, then makes another leg higher toward $90 to $100 if supply tightens further. This is pattern-based projection, not guaranteed, but based on historical silver bull markets, current supply, demand fundamentals, and technical structure, this timeline fits. Here's what matters. Silver at 61.92 isn't stuck randomly. It's consolidating after hitting an all-time high of 64.65. It pulled back 4% and held above $61. The forces that drove it from 27 to 64 are still in place. Industrial demand at records, supply in 5th consecutive year of deficit, inventories draining, investment demand rising. The barriers, technical resistance at $65 and Fed policy uncertainty are temporary. Technical resistance breaks when momentum builds. Fed policy will shift when economic data forces it. The pattern says consolidation followed by breakout. The timeline says the next major move happens within 2 to 4 weeks after markets reopen. Either silver breaks above $65 and runs to 75 plus, or it breaks below $60 and falls to $50. Based on fundamentals, the breakout has the edge, but markets are closed right now. Silver frozen at $61.92. And when trading resumes Sunday at 6 p.m. Eastern, we'll see which force wins. The buyers pushing for new highs, or the sellers taking profits at records. This is not financial advice. This is educational analysis of observable market patterns. Silver hit an all-time high Friday. It pulled back and closed at 61.92. Markets are closed for the weekend. And when they reopen, the forces that drove silver to $64 or $65 will still be there. The question is whether they're strong enough to push through 65 or whether profit-taking sends silver back down. The data suggests breakout. The pattern suggests continuation. But nothing is certain until markets reopen and volume returns. Silver isn't stuck. It's coiling. And coiled springs don't stay compressed forever. If you want to track what happens when markets reopen Sunday, the patterns to watch, and whether silver breaks through $65 or collapses, make sure you're following along. Because the next 6 hours could determine whether silver runs to 75 or falls back to 50. And understanding which scenario is unfolding in real time is the difference between recognizing opportunity and missing the move. Markets reopen in less than 6 hours. Silver at $61.92, all-time high at $64.65. The consolidation is set. The breakout or breakdown is coming. And history says the next move happens fast.